Bismillah ar-Rahman ar-Rahim. Assalamu alaikum wa rahmatullah. In this video, I'm going to explain the material covered in chapter 1. I will try to explain it as detailed as possible so you guys can refer to this video in case there is something that is not clear. And it also serves as an introduction to the material that we'll be covering for this chapter. The approach I'm going to follow is mainly I'm going to explain the concepts and the principles or the topics included in the slides, and from time to time I might ask questions, and I will pause for around 10 to 15 seconds to give you a chance to reflect and answer the question, and then you compare the question asked with my answer to the question. That way will help you better comprehend the topics that we will be covering in this semester and in this video, and it also makes the video a little bit interactive. So let's get started. Okay. What is a derivative? So the course is about derivatives or financial derivatives. We start the course by answering the question, what is a derivative? The simplest answer is that a derivative is a contract. So it's basically a piece of paper or bunch of papers in which two parties, usually, and sometimes could be more than two parties, signed this contract. What is special about this contract? Well, this contract is an enforceable legal agreement, which means once people sign the contract, it becomes legally binding, so they cannot change their mind unilaterally and exit from this contract. So if there is any changes in the contract, it has to be in agreement between all parties included in or involved in this contract. Now, this is not the only special feature about derivatives. A stock is also a contract. It's an ownership contract between the founders or the entrepreneur and the of a company or a project, and the financiers who are going to fund the company to enable it to start its operations. So we can see that also a stock is a contract. Is stock the only security that is considered as a contract, that we should consider it as a contract? Well, the answer is no. Also, bonds are contracts. A bond, it's a contract between the borrower, usually companies or governments, and lenders, who are investors or institutional investors. Okay. So if derivatives is a contract, stocks and bonds, which are financial securities, are also contracts. So how derivatives are different? Well, the fundamental difference between derivatives and all other types of securities is that derivatives derive their value on something else, from something else. The value of a derivative depends on another asset or even another variable. And we usually describe derivatives as instruments instead of securities for a reason. Now, some books might describe derivatives as securities, which is not an accurate or a completely accurate description, because at some points in time, derivatives could have a positive value for their holder, and sometimes they could be a liability on their holder, which we will discuss in later chapters. So because they have the possibility of having a positive value and a negative value, a better description or a better term to use with derivatives is instruments, because instruments is a general term. Examples of derivatives include futures, forwards, swaps, options, exotics, etc. What we will be focusing in this course are mainly the first 4 types, and we will be covering, we will introduce them in this video as well. Now, one might ask the following question: why we should care about derivatives? Why we are studying derivatives? The major reason derivatives are important is that they enable they enable transferring of risk. So in an economy, there will be a possibility to transfer risk from those who wants to avoid it or to eliminate it to those who wants to assume it or increase it. So the derivatives market, as we can see from the first point, they do not create wealth. The function of the derivatives market is giving participants the possibility of transferring risk. So there is no wealth creation. Now, is this the same role that the bond market or the stock market plays in an economy? No. What is the role of the stock market in an economy? Well, one of the reasons the stock market exists is to enable those who are seeking funding to be able to raise funds, and enable those who have funds but they don't know how to invest them to invest these funds. Now, that's not the only role. An important role of the stock market is to create wealth, because the objective of the companies listed in any stock market is to maximize the shareholders' wealth. And how the shareholders' wealth will be maximized is by increasing the stock price. So in the stock market there is a wealth creation, but in the derivatives market there is no such function. The main function of a derivatives market is to enable investors to transfer risk. Another reason why derivatives are important is because the underlying assets of derivatives include stocks, currencies, which are financial assets, interest rates, which are variables, commodities, which are real assets, debt instruments, also financial assets, and electricity prices, insurance payouts, the weather, and so on. So we can see that the underlying of derivatives are a wide range of real financial assets and other variables. And to give you an idea of how the size of the global derivatives market, the value of the underlying assets in the derivatives market is several times higher than the world GDP. In 2010, it was 10 times higher than the GDP. So this gives you an indication that the size of the derivatives market is not trivial. It's a huge market. Another reason why derivatives are important is because many financial transactions have embedded derivatives included in them. A prominent example is convertible bonds. So, what is a convertible bond? It's basically a bond that includes the right for the holder of the bond to convert the bond into a stock. Now, to value this convertible bond, can we use the traditional way to value a conventional or an ordinary bond? The answer is no. Why? Because we have to take into account this ability to convert, or this right to convert from a bond to a stock into account. It has a value by itself. So we need to learn how we can value this right, or this feature. And if we don't study for derivatives, we will not be able to do that. Finally, the real option approach to assessing capital investment decisions has become widely accepted. Now, let's remind ourselves what are the three major decisions financial managers make or do. From corporate finance, we learned that there are three major decisions that financial managers has to make. One of them is financing decisions. From where should investors or from where should we fund our company's projects? So are we going to raise funds from equity, from 100% debt, from a mix of between the two? This category of decisions focus on this part. The second decision is capital budgeting or investment decisions. So in this category of decisions, investors must decide on which project should we invest in, which project should we take, should we consider this project or should we reject it. So this set of decisions focus mainly on where should we use our funds that we raised initially, and how should we allocate it in the possible among the possible projects. The last type of decisions is the working capital decisions. So this focus mainly on the day-to-day operations and liquidity needs. Now, the real option approach has become more and more used in the industry to assess or to assess projects and make capital budgeting decisions. So in addition to its usage in the investment world and the real asset pricing field, it's now also used in corporate finance among the techniques that financial managers can use to evaluate projects. So it's important to understand what are financial options or ordinary options initially before we can move and use the real option approach. Okay. Next we turn to the decision. Next we turn to the question how derivatives are traded. Well, derivatives are traded in two main avenues. The first one is organized exchanges, like the Chicago Board Option Exchange, the CME Group, etc. The other avenue is the over-the-counter market, or the OTC market. So the OTC market is a market where the two parties meet directly and make deals and enter into transactions. So at least in the past, there was no intermediation between the two parties. Unlike in exchanges, the exchange clearing house is the intermediary between the two parties. And we will see what's the advantage of that compared to the OTC market in chapter 2. Okay, so again, the two major avenues where derivatives are traded are organized exchanges and the over-the-counter or OTC market. Now, the OTC market was blamed for the financial crisis that took place in 2008-2009. And although some of the arguments are valid, but not all of the arguments are agreed on with respect to blaming the derivatives market for the crisis. But some of the reasons that made people argue that the OTC market was the reason or the cause of the financial crisis that took place in 2008 is because the market was largely unregulated. In addition, the market was totally opaque. There was no transparency. No one knows what transactions took place, what are the underlying assets that were traded, who are the participants in these transactions, what are the specifications of the contracts. So there was no transparency at all in the OTC market. And usually in the OTC market, banks acted as the market makers. So they provide bid and offer quotes for any potential participant in a transaction. In chapter 2, we will look in more details about the mechanics of the transactions that took place in both the OTC market and the organized exchanges. After 2008 and after the crisis that took place in the US and was transmitted to all other parts of the world, there was a huge political pressure to regulate the OTC market. So there was huge reforms that took place, and the OTC market became largely regulated. And the objective of these regulations is to reduce the systemic risk that these markets or the OTC market might cause, and to increase transparency. So some of the standardized OTC products should be traded on what's called a swap execution facility, which are electronic platforms similar to exchanges. And when these transactions were executed on this platform, the level of transparency was enhanced, and it was possible for the regulators to monitor the market. We will see later that the central counterparties, or the CCP, were used to clear standardized transactions between financial institutions in most countries, and to increase the level of transparency of this market. All trades must be reported to a central repository. To show you the significance of the OTC market compared to organized exchanges, the size of the OTC market reached its peak in around 2007, 2014, 13 and 14, in which the value of the underlying assets were around $700 trillion, while the maximum value, the organized exchanges, the underlying assets traded on organized exchanges reached the peak of $50 trillion. So you can see the huge gap between the OTC market and the organized exchanges, and this also signals the significance and the importance of the OTC market. One might ask, okay, why does the OTC market, why does exchanges exist in the first place if the OTC market is so huge? Well, because it serves the need of certain segment of the market. In addition, not every individual investor can enter the OTC market. There are certain requirements in terms of the solvency, the capitalization of the participant to be able to enter the OTC market. Okay, we learned about what are derivatives. We learned why derivatives are important and how derivatives are traded. Now we answered the question how derivatives could be used. Well, there are 5 major usages of derivatives. The first and one of the important ones is to hedge risk. What does the term hedging means? Hedging means reduce or eliminate risk. So in Arabic, hedging means تحوط, والتحوط تأتي من أخذ الاحتياط. So وبالتالي تعني إنه لما تأخذ الاحتياط تستطيع مواجهة المخاطر أو تستطيع إدارة المخاطر التي تواجهها. So hedging mainly aims to reduce risk or to neutralize risk, or in some cases eliminate risk at all. And we will see whether this is possible or not. Another usage of derivatives is to speculate. And by speculation, what do we mean? So speculation in Arabic means مضاربة. المضاربة هدفها شراء أصل على أمل ارتفاع سعر الأصل ومن ثم بيع هذا الأصل والحصول على ربح. So speculation mainly is taking a view on the future direction of the market. If you believe the price will go up, you will buy an asset hoping that the price will go up, and then you will sell it and make a profit. If you believe the price will go down, then you will sell an asset, and if the price went down, you will buy it again and you benefit from the difference. A third important usage of derivatives is to lock in an arbitrage profit. And what do we mean by arbitrage profit? An arbitrage opportunity exists when there are mispricing between two or more assets, and investors can take positions in these assets in a way to lock in a profit. So no matter what happens to the prices later on, the investor is always sure that he will realize this profit. A fourth way to use derivatives is to change the nature of a liability. Now, some companies, they borrow from banks, and the borrowing agreement indicates that interest rates are based on whatever is the variable rate in the economy. So, for example, STC could take a loan in which it agrees with the lenders to pay the SIBOR rate. So if the SIBOR rate increased, the expenses the company will pay is going to increase as well. And if the expenses increased, the company will be worse off. It will affect their profit. So to avoid this potential risk, companies or STC could enter into a derivative to change or to transform the nature of its liability from being based on a variable rate to be based on a fixed rate. Okay. Another usage or the last usage of derivatives is also to change the nature of an investment. So we will see later in the course that you can use derivatives to change the nature of an investment without incurring transaction costs. Okay, that you would have to pay if derivatives did not exist and you want to change the nature of your investment. Okay, now next we turn to the available types of derivatives. So there are two major categories of derivatives that we will be covering in this course, and we should always remember. What are these two categories or the two types of derivatives? One is called forward commitments, التزامات مستقبلية, and the other is called contingent claims, مطالبات مشروطة. So under forward commitments, there are forward contracts, futures, and swaps. Under contingent claims, there are options, credit derivatives, asset-backed securities, and so on. In this course, we will be covering all types of forward commitments and options. Okay. Now we will be looking at each type of derivatives in more detail. So our introduction will be to the course will be as broad as wide as possible. What is the first type of first type of derivatives? It's the forward commitments. Now, what is special about this forward commitments contracts? Forward commitments are contracts entered into at one point in time that requires both parties to engage in a transaction at a later point in time. Okay, so to illustrate, just a second please, yes, to illustrate, now in a forward commitment, excuse me, let's say I signed a contract with Salim. So Salim is the seller and I am the buyer. Okay, Salim is going to sell me 1,000 barrels of oil at the price 55, and the delivery of the transaction will take place after 1 year. So what will happen today is that Salim and I are going to sign the contracts, specify different elements on the contract, the time of the delivery, which is going to be after 1 year, the number of units, the price, other specifications. And both Salim and I must wait until the expiration of the contract or the maturity of the contract, which is after 1 year. So after 1 year, the actual exchange will take place. Today, no exchange will take place. There will be no exchange of cash, no exchange of commodity, nothing. Just a commitment from Salim and a commitment from myself to engage in this exchange after 1 year. Now, in the spot market, is it the same? In the spot market, well, if I agreed with Salim to sell me oil and we signed a contract, okay, the exchange will take place immediately. So immediately I will pay 55,000 for the 1,000 barrels of oil, and Salim will deliver to me the 1,000 barrels of oil. So we can notice here that the time that the contract is signed, or the time both parties entered into the contract, is the same as the time the exchange will take place. That's for the spot market. For the forward commitment contract, that's not the case. We signed the contract at time 0 or today, and the exchange will take place at a different time. In our example here, after 1 year. Okay. So, main element in the forward commitment contract is that the time the contract is signed is different from the time the transaction takes place. The price and the date of the transaction must be defined or determined at the time the contract is signed. So both parties know after 1 year how much the buyer will pay and how much the seller will receive in exchange of what exactly. Before we proceed, we must agree on some terminology that is used in the industry, and we're going to widely use it throughout the course. Now, in previous example, the party that has agreed to buy has what is termed a long position, or has taken a long position. And the party that has agreed to sell has what is termed a short position, or entered into a short position. So moving forward, I would like to hear from you guys the description of the position you will take by saying I will take a long position in XYZ, or I will take a short position in ABC. Okay, now we will look in more detail in the different types of derivatives under the forward commitment category. The first one we will be covering is forward contract. or are forward contracts. What is the major feature of a forward contract? What differentiates forward contract is that it's an over-the-counter derivative in which the two parties agree that one party, the buyer or the party who took a long position, will purchase an underlying asset from the other party, the seller, at a later date at a fixed price they agree on when the contract is signed. So the buyer assumes which position? A long position. The seller assumes which position in the contract? A short position. So in addition to the price, the contract also specify other items or other matters, which includes what is the underlying asset, the number of units, the location of exchange, the quality of the underlying asset, and so on. One important element in the forward contract is the forward price. Now, the forward price in a forward contract is the delivery price that would be applicable to the contract if they were negotiated today. Okay, so the forward price, which is the important one and the important elements in the forward contract, is the price that would be applicable to the contract, okay, at the delivery date or at the maturity date of the contract. Now, another definition of the forward price is the delivery price that would make the contract worth exactly zero. We will be looking at this matter in chapter 5 in more detail to understand the value of derivatives contracts in general. The forward price is not fixed for is not fixed for all available maturities. Logically speaking, we should expect a different price for a contract of different maturities, as we will see in the next table. So in the table here, we will see quotes for the Great British Pound, the GBP, against the dollar. Now, if you want to buy the GBP in the spot market, you will be paying this price. And if you want to buy or you want to enter into a forward contract where the GBP will be delivered to you after 1 month, the price is 1.4548. If you want to enter into a forward contract in the GBP where the delivery or the exchange will take place 6 months from now, you will be paying 1.4561. Now, you notice here that there are bid and offer prices, or bid and ask prices sometimes it's referred to. So what's the difference between the bid and the offer prices? Now, the bid price, now you have to keep in mind that these prices are from the perspective of the market maker. So if the market maker could be investment bank or someone else. Now, when you ask the investment bank for the bid and offer prices, the market maker will tell you that he or she is willing to buy at this price, the British pound, and is willing to sell you the British pound for this price. So you observe that always the offer price are higher than the bid price, because the difference between the bid and offer is the profit for the market maker. So he buys at a low price and sells at a higher price, and the difference for the market maker determines the profit. Examples of forward contracts on May 3rd, 2016, the treasurer of a corporation enters into a long position in a forward contract to buy 1 million sterling pound for delivery in 6 months. And the forward price or the forward exchange rate is 1.4561. What does it mean? What does this commitment mean? It means that the treasurer or the company has the obligation to pay 1,456,100 for 1 million pounds on November 3rd, 2016. What are the possible outcomes for the sterling pound? Well, either the price is going to be, let's say, the spot price at time t either will be higher than 1.4561 or it could be lower than 1.4561, or rarely it could equal to 1.4561. Let me ask you this question. If on November 3rd, 2016, after the treasurer entered into the forward contract, the price in the market was in the first case, so let's say for example it was 1.6. Did the treasurer benefit from entering into this forward contract? So to answer this question, we have to look at the scenario where the company entered into the forward contract and the scenario where the company decided not to enter into the forward contract. And let's assume that for let's say imports from the UK, the company signed a deal with an exporter to receive 1 million sterling pound in order for the export to be shipped to the US. So they have a commitment to deliver 1 million sterling pound after 6 months. Now, if the price of the sterling pound on November 3rd turned out to be 1.6, and the treasurer entered into the forward contract in which he has the obligation to pay 1.4561, did the company benefit or lose from this transaction, from the forward contract? Well, the company benefited. Why? Because if the company did not enter into the forward contract, it will pay 1.6 for every sterling pound. So in total, it will pay 1.6 million. But because it entered into the forward contract, it's going to pay 1.4561 million. Okay. The other possible scenario is that ST is less than 1.4561. So let's assume that in the second scenario, the exchange rate for the sterling pound reached 1.1. Now one might argue, okay, this is an example that the company should have not entered into the forward contract because it's going to pay a higher exchange rate. Now the treasurer should have this in mind, and most likely the treasurer decided to enter into the forward contract because the company can afford to pay 1.4561 per sterling pound, but the company cannot afford to pay higher than that. So to fix the price and avoid this risk of not being able to meet their commitments to make available 1 million sterling pound, they entered into this contract. Even though they might end up paying a higher exchange rate than what's available in the market. So they're willing to take this risk for various purposes. One possible purpose is that when the company initiated the forward contract, there was an expectation that the sterling pound will go up. So the company has to do something to manage its risk. Okay, next we will be examining the profit or payoff diagram. Possibly here, I believe the payoff diagram is more appropriate. The payoff diagram from a long forward position. Let's base our analysis on the previous example. So K, which is the delivery price, it's 1.4561. Now, if the transaction, or let's say if the forward, if the price of the underlying at the maturity is greater than K, then clearly the long investor has benefited or has a positive payoff out of this transaction. Because as we explained, if it was 1.6, the company has the ability to buy the sterling pound at a cheaper price compared to what is available in the market. If the price is lower than K, as in our previous example, 1.1, so 1.1, the company has a negative payoff, or we could say it made a loss. And the loss is an indirect loss because the company entered into a commitment to pay $1.4561 per pound, while at time T, the spot price of the sterling pound is 1.1. So now in the second scenario, the company is paying more than what is available in the spot market. So the result is that it made a loss, or it has a negative payoff. How about what will be the position or the payoff for the short investor, the investor who took a short position in the forward contract? Now, same example, K is equal to 4561. If the price ended up K 1.4561, if the price ended up being 1.6, the investor has an obligation to sell sterling pound for 1.4561, and at time T, at the maturity of the contract, the spot price is 1.6. So did the company benefit from entering into this contract or no? In the forward contract, they have the investor has the obligation to sell one sterling pound for 1.4561. If the investor did not enter into the forward contract, the investor will be able to sell the sterling pound for 1.6. So as a seller or someone who's selling, you would like to receive a higher price for the thing that you are selling. But as a buyer, you would like to pay the lower price for the thing that you are buying. So since here the price is in ST is greater than the delivery price K, the short investor made a loss in the first scenario, or the payoff is negative. if in the second scenario the price was 1.1, so the investor is able to sell at 1.4561, and in the market the price was 1.1, so he benefited from this contract because he will be able, or he has the obligation to sell at a higher price compared to what's available in the market. Okay, now I want you to examine the relationship between the two charts, the short and the long. What do you notice? You can see that the profit for one party is the loss for the another party, and the same, the loss for the other party is the profit for the first party. So this shows a fundamental relationship in derivative transactions, which is derivatives are a zero-sum game. The loss of one is the profit for the other. Okay. Next, we will turn to the other type of derivatives under the forward commitment contracts, which are futures contracts. Now, futures contract is similar to the forward contracts, in which it's an agreement to buy or sell an asset for a certain price sometime later, okay, at a certain time specified in the contract. However, the futures contracts are traded in an organized exchanges, whereas the forward contracts are traded in the OTC market. Now, there are three major differences between futures contracts and forward contracts. The first is that futures contracts are standardized. So there are there are certain specifications in the contract that the two parties cannot change. This includes the number of units in the contract, the location of the exchange, when the contract is going to mature. There are options, but the two parties cannot change these specifications. Then who set these features in the contract? Well, the major elements in the contract are set by the exchange on which the futures contract is traded. The second difference is that in futures transactions, there are daily settlements of gains and losses. So every day, the party who's gaining from the transaction is going to receive the gains, and the party who is losing has to pay these losses. And in chapter 2 we will see in detail the mechanics of the futures market and how the daily settlements really work. The third difference between futures and forwards is that the exchange clearing house provide a credit guarantee. Now, in the previous example, where I entered with Salim into this forward contract, isn't it a possibility that I will tell Salim, I changed my mind. I don't want to buy from you these 1,000 barrels of oil, so I'm not willing to continue with this contract. Isn't this a possibility, especially, for example, if the oil prices was dropping, and for me it was better to buy it from the spot market than to buy it from Salim after 1 year. So there is a possibility that I will say, you know, I will not continue this agreement. Then what Salim will do, Salim will file a lawsuit, and there will be a series of legal battles in the court, and this will cost Salim a significant amount of expenses. Okay, forget about this scenario. Is it possible that I will cease to exist? Okay, I might go bankrupt, and Salim counted on selling this amount of barrels of oil on to me and receive the cash. So there is a risk that I will not be able to meet my obligation in the forward contract. And what do we call this type of risk? It is similar to a default risk. So in a default risk, I'm not able to pay my expenses or my interest expenses, or I'm not able to retain back the face value of the loan. Here is the same. I'm not able to pay the amount I am obliged to pay to Salim. So this is kind of a credit risk. Now, in the futures market or in organized exchanges, the clearinghouse will assume the role of the party who has defaulted or went into a problem, so the counterparty will not be affected as a result of what happened to the first party. And this kind of provide a credit guarantee that all transactions will be fulfilled. There's a guarantee that the transaction will be fulfilled. Now, this slide shows a snapshot of the contract specification of live cattle in the CME group. So here it shows the ticker symbol. What is the contract size? In the case of live cattle is 40,000 pounds, and the deliverable grades are based on or used what is known in the agricultural industry, where people understand what these grades refer to. The contract month, when there could be a maturity or an expiration for the futures contract. So there are contracts that expire in February, in April, in June, in August, in October, and December. And it also specifies the trading hours. If trading took place in the trading pit, where trading was physical between the two parties in the futures contract, this is the trading the trading hours. If the trading is done on the electronic platform, then this is the trading hours. The last trading day of the also very important day to keep an eye on in any futures contract is when the contract when is the last trading day for the contract. So in the case of live cattle, it is the last business day of the contract month. Okay, other contracts could have different specifications, so it's important when you are trading futures to know when you can exit from if you decided not to continue the contract, when is the last trading day and when is the last delivery day. So here it's also important, if the two participants want to enter into an actual exchange, to know when is the last delivery day. The price quotes, some technical specifications, the tick size, the daily price limits are all specified in the contract specifications. Examples of exchanges that trade in which all futures are traded, is the CME Group, which the CME Group is the largest exchange globally that trades futures. It also includes options, but it mainly focuses on futures. And the CME Group was formed when the Chicago Mercantile Exchange merged with the Chicago Board of Trade, and that happened around 2000 in the 2008-2010 period. I don't really recall the exact date, but it happened in the last decade for sure. Another example is the Intercontinental Exchange, which is an American exchange that trades futures. The BM&F, it's a Brazilian exchange. The TIFFE is a Japanese exchange, and there are more exchanges. I provided a list in the chapter 1 folder that shows also the exchanges, the regional exchanges that trade futures. There is in Dubai at least 3 exchanges that trade futures. So it's important for you guys to be familiar with these exchanges in our region, to know what are the what is available for derivatives traders in our region. Examples of futures contracts, for example, is an agreement to buy 100 ounces of gold at $1,300 per ounce for delivery in December. So the futures contract specify the number of ounces that traders can exchange in any futures contract. Also, for example, a futures contract to sell 62,500 sterling pounds for delivery in March at $1.45 per pound. Again, the 62,500 pounds is set by the exchange. Also, an agreement or a contract to sell 1,000 barrels of oil for delivery in April at $50 per barrel of oil. Again, the 1,000 is set by the exchange. The maturity, the available maturity, which is April or March or December, all are set by the exchange. Now, what is left is the prices. So, do you think the prices are set by the exchange or set by the investors who are trading futures contracts? I will leave this question for you to contemplate. Okay, now we will look at an example for an arbitrage opportunity. Now, suppose that we observe the following prices in the market. So the spot price of gold is 1,200. The 1 year forward price of gold is 1,300. And the 1 year US interest rate is 5% per annum. Is there an arbitrage opportunity? Well, let's say that someone told us, yes, there is an arbitrage opportunity. And to take advantage of this arbitrage opportunity, you need to do the following today. So, today, what we will do, I will borrow $1,200 at 5% for 1 year. Okay, what I will do with this 1,200, I'm going to buy 1 ounce of gold from the stock market. Okay, which means I'm going to use the 1,200 to pay for the 1 ounce of gold. And what else I will do today? I will short, or I will enter to just a second, please. So I will enter into a short position to deliver 1 ounce of gold at 1,300 after 1 year. So I took all the necessary positions that I need today to take advantage of this arbitrage opportunity. Okay, what could possibly, after 1 year, what are the possible, or what are the commitments that I have to take care of? What are my obligations that I have to meet? So remember, we borrowed cash, so we have to return this the amount we borrowed. I entered into a short position, which is a commitment to sell 1 ounce of gold after 1 year. So I have to deliver this amount and receive the deliver the 1 ounce of gold and deliver it's the price we agreed on when we signed the contract. So after 1 year, the loan will grow to 1,260. To be able to pay back the loan, I need to receive some cash because I don't want to pay anything from my pocket. To receive cash, I will execute the forward contract, which means I'm going to deliver the 1 ounce of gold and I will receive in return 1,300, which is the price we agreed on when we entered into the forward contract. Now I pay back the loan, which means I'm going to pay 1,260. I received 1,300, so the difference, which is 40, is a profit that I will keep in my pocket. Now from this example, I want you to observe, did I pay anything from my pocket? Okay, that's number one. Number two, do I care about what will be the price of gold after 1 year in the spot market? If the price of gold is 10,000, does it matter in our case? If the price of gold reached to $10, does it matter in our case? Both answers are no, because the position I entered into the futures contract is going to ensure that I'm going to receive this price no matter what happens to the spot market. Okay, so we observe here that yes, there is an arbitrage opportunity, and we observe how we can benefit from this arbitrage. Now, I don't want you to worry about the mechanics of how we calculated the profit. How did we decide which position we entered into, and how we determined that, because we will be discussing this in chapter 5. Here I just want to give you a taste of how arbitrage arguments are important, and how it is possible that if there is mispricing in the forward market, in the derivatives market, there might arise arbitrage opportunities. Now, a second scenario is that the spot price of gold is the same 1,200, but we observe that the 1 year forward price of gold is also 1,200. The 1 year US interest rate is 5% per annum. The question is there an arbitrage opportunity? As in the previous scenario, let's say here, someone told us, yes, there is an arbitrage, and to benefit from this arbitrage, we need to do the following. So, today, I'm going to short sell 1 ounce of gold. What do we mean by short selling? It means that you are going to borrow from someone 1 ounce of gold and promise that you will return this 1 ounce of gold sometime in the future. Now, you borrowed this 1 ounce of gold, you are going to sell it in the spot market, and when you sell the 1 ounce of gold, you will receive 1,200, which is the price we observe in the spot market. What I will do with the 1,200? Am I going to invite my friends for a dinner, or go to do some shopping with it? No. As investors, I'm going to invest this fund in the risk-free asset. In other words, I'm going to lend it at the risk-free rate. And finally, I'm going to enter into a long position in the forward contract to buy 1 ounce of gold at 1,200 after 1 year. Okay. So what will happen, or what should I do after 1 year? So after 1 year, my risk-free investment will grow to 1,260. Now, I have a commitment to buy 1 ounce of gold at 1,200, and I also have a commitment to return the 1 ounce of gold from the party who lent it to me. So to be able to meet these two commitments, I'm going to use some of the funds I received from my risk-free investment to pay for the 1 ounce of gold I committed to buy in the forward contract. So I'm going to execute the forward contract and pay 1,200 and receive 1 ounce of gold. I'm going to take this 1 ounce of gold to cover my short position, which means I'm going to return the gold to the person who lent it to me. And is there anything else I can do? No. Now I calculate the arbitrage profit, which is I received 1,260 and I paid 1,200. So net I received a profit of $60. Again, did I pay anything from my pocket? Is there any uncertainty about this profit? Is there any risk associated with this profit? Does the price in the spot market is the price in the spot market relevant in our calculation of the profit? No. So you can see that this profit is riskless, because no matter what happens in the market, I'm always going to receive 60. So an arbitrage profit is a riskless profit that I'm going to receive no matter what happens to the market, and usually without investing any funds from my pocket. Now, is arbitrage profit real? Well, they are rare. To be clear, they might exist because of mispricing in the market. But since markets are efficient, and since there are not hundreds, not thousands, tens of thousands of arbitrage hungry investors who are constantly monitoring the market to spot or to detect arbitrage opportunities. So if there is any mispricing of this sort, in a matter of seconds, the market will correct this. Now, what do you observe, or what do you think will happen to the spot price of gold and to the forward price of gold in the first or the second scenario? And in the second scenario here, since a lot of investors will or plan or want to take advantage of the arbitrage opportunity, there will be a huge orders of selling gold in the spot market. So if there is a huge pressure or a huge quantity of gold that are sold in the spot market, what will happen to the spot price? It will go down. And if there is a huge demand to enter into the long position in the forward contract at the forward price, what will happen to the forward price of gold? Since there is a huge demand, the amount of the price of gold will go up. So the spot price of gold will go down, the future forward price of gold will go up, until there will be until the forward price and the spot price reach a level where it's impossible, or there is no arbitrage opportunity. So this illustrates one of the fundamental laws that govern derivatives prices. The law of the price of no arbitrage. Now, is the forward price of gold is determined arbitrarily without considering the spot price of gold? The answer is no. The forward price of gold in our example here is equal to the spot price times 1 plus r to the power of t. So from the term derivative, you can see that the forward price depends on the spot price. Okay, so if the spot price went up, what will happen to the forward price? It will go up as well. If the spot price went down, what will happen to the forward price? The forward price will also go down. So there is a relationship between the forward price and the spot price. If the relationship holds, then there will be no arbitrage. If the price we observe in the market is different from the price we calculate for what should be the forward price, then there will be an arbitrage. So in our examples, the forward price at which there will be no arbitrage opportunity is 1,260. And you might observe in the both cases, 1,260 is a common number between the two examples. Okay, and it comes from the fact that based on this equation, the forward price is determined. We will be discussing now issues related to the determination of forward and futures prices in chapter 5. So here I'm just giving you a hint about that topic. Now, let's look at a different type of an asset. Here we have oil, and we are wondering whether there is an arbitrage opportunity. Now, suppose that the spot price of oil is, we observe in the market, is 50. The quoted 1-year futures price of oil is 60, and the 1-year US interest rate is 5%, and the storage cost of oil is 2% paid in the future based on the current price of oil. So is there an arbitrage opportunity? Well, let's see. So today I'm going to borrow $50 based on the risk-free rate I observe in the market for 1 year at 5%. I will use this $50 to buy 1 barrel of oil from the spot market at $50 per barrel. I will store it for 1 year. The storage cost is 1%, payable after 1 year based on the current spot price. And then I will enter into a short position in the forward contract to sell 1 barrel of oil for delivery after 1 year at $60 per barrel. So here I have taken all the necessary steps to lock in an arbitrage. So after 1 year, the loan will go to 52.5, and I have to pay the storage cost, which is $1. We got the $1 based on the 2% of the $50 per barrel of oil, and I'm going to execute the futures contract, which means I'm going to deliver 1 barrel of oil and receive $60. I'm going to use this $60 to pay back the loan and pay the storage cost, and whatever is left will be my arbitrage profit. So my arbitrage profit will be 60 minus 52.5 minus $1, and what is left is $6.5 per barrel. So the answer, yes, there is an arbitrage opportunity. Now, let's look at a different scenario for oil. Now, suppose that the spot price of oil is 50 and the quoted 1 year futures price of oil is 40. And the 1 year US interest rate is still the same 5% and the storage cost is still the same 2%. Is there an arbitrage opportunity? Well, as we saw in the gold example, if we believe that the futures price is lower than the spot price, then I need to enter into a long position in the futures contract to buy oil after 1 year at $40 per barrel, and I need to short sell oil in the spot market and receive 50. Now let's focus on this part here. Short selling oil means I have to go and find someone to lend me oil so I can take it and sell it in the spot market. Now in the gold market that is possible, but in the oil market, is that possible? Well, is it possible to find someone who's willing to lend me oil and wait for 1 year to return back the oil I borrowed? And the answer is no. Why? Because oil is used for consumption. So they either can use it as an input in their production process, or either they can use it in to sell it and receive cash. So for some products, we might be able to take advantage of arbitrage opportunities if there are mispricings, but for other products, that is not possible. So in the case of oil here, and in this scenario specifically, we cannot take advantage of mispricing between the spot price and the futures price, because we cannot short sell oil in the spot market. Again, all this is just an introduction. We are going to focus on this topic in more detail in chapter 5. Okay, now let's turn to options. So we introduced to you futures and forwards. Here I'm going to introduce to you options. Now, what is an option? An option is the contract that gives its holder the right but not the obligation either to buy or sell depending on the type of the option, at a certain price on or before a certain date. Now we have two types of options. We have a call option. A call option is an option that gives the holder the right to buy a certain asset by a certain date for a certain price. This certain price, we refer to it by the strike price. The put option, the other type of options, is the option to sell a certain asset, okay, by a certain a certain date for a certain price. To give you an idea of how options work, I want to share with you my talent in drawing, which I usually share with my students in this class. So in this drawing, it illustrates the relationship between the two parties in any option, whether it's a call or it's a put. So it's the right to buy or the right to sell, it doesn't matter. In any option, we have the buyer or the person who took a long position, and we have the writer or the seller or the investor who took a short position. So they all refer to the same person. The buyer, the long, refers also to the same person. Now, at the time the contract is signed, the option contract is signed, the buyer and the seller, they signed the contract, okay. The buyer will pay to the seller the premium, okay. So there is an exchange of cash when the contract is signed. Sometime in the future, if the buyer decided to exercise, so the buyer has the right only, but not the obligation. Sorry, what's this? Okay, so the buyer has the right, while the seller or the writer has the obligation. So if the buyer decided to exercise the option, the seller either will pay the difference, okay, between the spot price and the exercise price, or either will sell the underlying asset in the case of the call, or will receive the underlying asset and pay cash in the case of the put. Okay, I hope you enjoy my talent in drawing. Now, in terms of the timing of exercising the option, there are two popular types of options, which are American and European options. Now, the difference between the American and the European option is that, let's say here is the exercise date. In the European option, you can only exercise on the exercise date. In the American option, you can exercise, you have the right to exercise anytime during the life of the option, from the time the contract is signed until the exercise date. After the exercise date, the option is going to vanish. It's going to be null, void, does not exist anymore. Here you can see the Google call option prices on May 3rd, 2016. And the prices are quoted according to what is the strike price in the option and when is the option going to expire. So you can see that there are call options that expire in June 2016, so a month after the date we see the prices, in September 2016 and December 2016. And you can see that there is a bid and offer prices. Now, what I want you to look closely at is how the price of the option changes with the strike price. Now, what is the call option? A call option is the right to buy. And as a person who is going to buy, would you like to pay a higher price for the thing you want to buy, or would you like to pay a lower price for the thing you want to buy? Logically speaking, you would like to pay a lower price. What do you notice here? An option that gives you the right to buy Google stock for 660 has a value of 43.40. Whereas the option that has or gives its holder the right to buy Google stock at 740 has a price of 4.7. Why that's the case? Because the option with a lower strike price, the option which gives you the right to buy Google stock at a lower price, is valued higher than the option that gives you the right to buy Google stock at a higher price. Because as a buyers, we like to buy more we like to pay less, okay, for the thing you want to buy. So we will learn more about these relationships, but I just want to give you a taste of the relationship between the option price and the one important element in the option contract, which is the strike price. Here we see the quotes for Google put option prices on the same day. So again, we see there are options that expire in June, in September and December, and we see different strike prices. Let's remind ourselves, what is the put option? A put option is an option that gives its holder the right to sell the underlying, in our case, to sell Google stock at a certain price on or before a certain date. Okay, what do we notice here? As the strike price increases, what happens to the price of the put option price? Well, the put option price increases. Why that's the case? Well, an option that gives you the right to sell at 660 is preferred less than an option that gives you the right to pay to sell at 740. Since 740 is a higher price, and since we are selling Google stock, and since sellers like to receive a higher price for the thing they are going to sell, we see a positive relationship between the put option price and the strike price. Here we are going to quickly compare between options versus futures or forwards. Now, futures and forwards, as we saw, they give their holders, both buyer or seller, long or short, they give their holders the obligation to buy or sell at a certain price. So both parties have the obligation. They cannot choose once they sign the contract. On the other side, options give their holder the right, so there is no obligation on the option holder or the option buyer. It's only the right to buy if we are dealing with the call option, or to sell if we are dealing with the put option at a certain price. Now we heard about the underlying asset, and it might not be clear for some what is really the underlying asset. Now, in all derivatives, as we learned, are based on the performance of some other factor. This some other factor could be a real asset, like commodities or metals, could be financial assets, like stocks or bonds, or even indices, interest rates, if we consider them financial assets or financial factors. And it could be other factors, variables, like the volatility of the S&P 500. So the volatility is not an asset, it's a factor. The temperature, there are derivatives on the weather. So the temperature or the weather is a factor. There are derivatives on the damage that is caused by hurricanes. So the strength of the hurricane is the factor. Okay. Now, and that's why we use the term derivatives, because these contracts derive their value from some other factors. Something else. This, as I said, something else. It's a general term that refers to assets or even factors. Okay. Now, we turn to the types of traders in any derivatives market. So, for the derivatives market to function properly, we need all of these three types of traders. So, who are these three types of traders? The first one is hedgers, and hedgers are market participants seeking to reduce or eliminate their risk. The other type of traders are speculators, and speculators are market participants seeking to assume or increase their risk. So they're willingly want to increase their risk, hoping that they will receive a higher payoff. The third type of traders are arbitragers, and arbitragers are market participants seeking to do what? As we saw from the examples, they are seeking to take advantage of mispricings between the spot and the futures market to lock in arbitrage opportunities. Hedging examples: a US company will pay 10 million sterling pound for imports from Britain in 3 months and decide to hedge using a long position in a forward contract. Another example: an investor owns 1,000 Microsoft shares that currently worth 28 per share, and this investor decided to hedge his portfolio of Microsoft shares by entering into a 2-month put option with a strike price of 27.50, and this put option cost $1 per share. So the investor decides to hedge by buying 10 contracts. Now, each put option contracts include 100 put options. So the contract is a bundle of put options, or a package of put options. Okay, when we are valuing puts or calls, we are not valuing contracts, we are valuing options, individual options. But since in the organized exchanges options are traded in bundles and contracts, we need to also make ourselves familiar with the term option contracts. So since each option contract has 100 put options, the investor decided to hedge by buying 10 contracts. So 10 times 100, in total he will have 1,000 put options to hedge his ownership of Microsoft shares. This chart here will shows us what will be the value of the investor's holding with or without hedging. So without hedging, we notice that as the price goes up, the value of his holding will also increase. But as the value goes down of Microsoft stock, the value of his holding is going to decrease. Now, in the case of hedging, as the value goes up, the value of holding of Microsoft shares is going to increase, but it's always going to be lower than the case of no hedging. Why do you think that's the case? Why there is a difference between the case of no hedging and the case of hedging? Exactly, it's because of the premium the investor pays to buy the put options. Now, as the price of the Microsoft stock goes down, since the sorry, what happened here? Since the investor has a put option that gives him the right to sell Microsoft stock at 27.5, so he guaranteed that if the price went below 27.5, he can exercise his option and sell Microsoft stock at 27.5. So at any price below 27.5, he can ensure that he will receive 27.5. So in a way, the option here acted like an insurance policy for the put option, acted like an insurance policy for the investor. A speculation example. An investor with $2,000 to invest feels that the stock price will increase over the next 2 months. So based on his belief, he's evaluating whether he should enter into stocks directly or invest in call options. Now, the current stock price is 20, and the price of a 2-month call option with a strike price of 22.5 is $1. What are the alternative strategies the investor has? Well, let's see. Okay, so the investor has two alternatives, either to invest in stocks or to invest in call options. If he invested in stocks, then the 2,000 will yield him 100 stocks. If he invested in call options, then the 2,000 will enable him to invest in 2,000 call options. Let's evaluate each alternative investment at different prices. If the price of the stock increased to 30, what will be the value of his investment in the stocks? So he has 100 stock times 30 minus 20. So his net profit will be 1,000. In the case of call options, we have to keep in mind that the investor is going to, whether the investor will exercise the call option or not. So if he is going to exercise the call option, then he is going to, let's see, the call option gives him the right to buy the stock at 22.5. So and the current price of the stock is 30. Does it make sense to exercise the call option? The answer is yes. It's better to exercise the call option, buy it at 22.5, and then sell it at 30. So he has 2,000 options, and he is going to sell it at 30 and he is going to exercise and buy it at 22.5. Okay, and we have to also remember that he paid 2,000 as premium to enter into the option, so we have to take it into account in our calculations. So in net he is going to receive 13,000. So you can see that the same change in price yielded 1,000 profit in the case of investing in the stocks and 13,000 in case of investing in the call option. Like, what if the stock price went down to $10? So in this case, definitely he is going to incur a loss. So the loss he is going to recognize is 10 minus 20, which is equal to minus 1,000. So he lost 1,000, but he did not lose the whole investment. He still has 1,000 worth of stocks from his portfolio. Now, in the case of call options, does it make sense to exercise the call option? Yeah. The price in the stock market is $10 and the option gives you the right to buy the stock at 22.5. So as a rational investor, are you going to exercise this option? If you really want to buy the stock, you don't have to pay 22.5. You can go directly to the market and pay $10. So in this case, the option will expire worthless and the investor is going to lose the whole premium he paid in the option. Since he's not going to recover anything from the option, he's going to lose all his investment in the option. Now, you can see from this example that speculating using derivatives is very risky, because it might lead you to a scenario where you are going to use the whole amount you invested in the call option. Okay, if your expectation turned out to be correct, the profit will be highly leveraged. You can see that same change in price led to 13 times higher a profit that is 13 times higher than investing in the stock directly. But if things went wrong, then you are going to lose your whole investment. Let's quickly look at an arbitrage example. Now, let's assume that a stock is quoted as 100 sterling pound in London and 150 in New York, and the current exchange rate is 1.53. So what is the arbitrage opportunity? Well, if we converted the stock that is traded in London into US dollars, we will find that the stock price is $153 in London. So as a rational investor, you can short sell the stock in London, buy it, buy the stock from use the fund that you will receive, which is 153, buy the stock from New York, pay 150, close or cover your short position in the stock in London, and you keep in your pocket $3 as a profit. Now, this case does not take into account that there are transaction costs, that there are bid-ask spreads, there are other factors that might make this arbitrage opportunity or making an arbitrage profit impossible. Now, we discussed the usage of derivatives. we need to keep in mind that engaging in derivatives there are dangers involved in engaging in derivatives. One of these dangers is that sometimes traders, even sophisticated ones, they might switch from being hedgers to become speculators. So instead of reducing their risk, they're increasing their risk unknowingly. Or they sometimes can give the impression that they are arbitragers, whereas in fact they are speculators. So if investors do not know exactly what they are doing and what are the consequences of the steps or the positions they took, the consequences could be disastrous. Yeah. There are many cases for misusage of derivatives. Societe Generale in 2008 discovered that one trader who gave an impression that he's taking positions to lock in arbitrage opportunities, where in fact he was speculating using derivatives. And when they discovered the positions that he entered into, and they closed it because they don't want the losses to increase, the loss they recognized was 5 billion euros. Procter and Gamble lost in 1994 150 million as a result of unwell managed hedging program. Baring Bank in 1995 lost 1.3 billion because of engaging in derivatives. The hedge fund, long-term capital management, which is a very famous hedge fund, lost in 1998 3.5 billion. And if it was not bailed out, it could have dragged the whole US economy with it because of the huge amount of positions they had at that time. In 2008, also AIG, they lost $5 billion in CDS, credit default swaps. So you can see that failures in using derivatives properly could lead to a huge amount of losses that might drive some entities to go bankrupt. Because of that, you can hear that there are criticism of derivatives or of the derivatives market. Some people will argue that there are speculators who do not know exactly what they are entering into, and these speculators are causing a huge risk to the whole economy. Now, the answer to this criticism is we should blame derivatives or the users of derivatives who did not use it properly. It's the same when someone is playing with the electricity and get shocked. Should we blame the electricity or the person who was not careful when he was dealing with the electricity, or a person who was playing with fire and caused a huge fire? Should we blame the fire itself or the person who dealt with the fire carelessly? Of course, we should blame the users of derivatives, not the derivatives market itself, because at the end, derivatives market neither create nor destroy wealth. The main function of derivatives market is to transfer risk. Other people will argue that derivatives is like gambling. Well, because some people are losing and some people are benefiting, and it's all based on expectations. But to answer or to address this criticism, we have to answer the following question: who benefits from the gambling? Usually, who benefits from gambling are the people who work in the casinos or in the gambling industry, not the whole economy. Whereas in the derivatives market, who benefits is the whole economy. When derivatives enable the transfer of risk from people who wants to assume it, who wants to reduce it or eliminate it, to those who wants to assume it or increase it, then the whole economy is going to benefit. Of course, there has to be monitoring to make sure that those who wants to assume risk, they can bear it. Because if they cannot bear it and they are too big to fail, they will cause a huge headache for the whole economy and the policymakers. Now, misuses of derivatives include derivatives participants or users of derivatives must keep in mind that derivatives are highly leveraged, which means a small change in price will cause it could cause a huge amount of profit, and at the same time it could cause a huge amount of losses. So if you don't use derivatives properly, then you might cause yourself a huge amount of losses because you don't know what you are dealing with exactly. If you don't have the requisite knowledge to deal with derivatives, it will lead you to use it improperly or inappropriately. And in such a case, it might lead to disastrous situations. So that's why we have to keep an eye on. Whenever we are dealing with derivatives, we have to be extra careful. Now, we will end with the discussion of some people argue maybe derivatives are an important topic or a nice topic, and it might be interesting to learn, but it really has only applications for multinational companies. For individual investors, maybe they will include options or futures in their portfolio for a short period of time, but other than that, it doesn't have any applications. Well, the answer to this is not true. More and more now, small businesses are using or adapting risk managements that involve derivatives in them. An important reason why derivatives are important in general for companies is that it enables investors or companies to manage some risks that they could avoid, and it's not part of their main business. For example, a company that manufactures furniture, it is faced with some risks that are acceptable, like the change in the customer's tastes in terms of what is required in the furniture products, or the increase in demand, or the increase in competition. So these types of risks are a part of the business. So there is no business without risks. But if the furniture company is also importing wood from outside of the country, or they have a loan that is based on a variable interest rate, so the company here is exposed to fluctuations in the exchange rate, and it's also exposed to increase in the variable interest rate. So the company should focus only on the area where it has expertise, which is coming up with products that need the demand of its clients and makes it ahead of its competitors, and avoid the risks that are under of its outside of its control, like the foreign exchange price or the interest rates. So you can see here that even for non-financial companies, there is an application, a useful application of derivatives that helps the company achieve its objectives. Some small business owners are also using derivatives. I know a shop that sells PC parts that engages in futures contracts to buy PC parts and avoid the fluctuations that happen in these parts which they face on a daily basis. Also, now more and more funds are using options or other derivatives as part of their portfolio. So learning about derivatives will give you the skills that helps you to meet the demand, increasing demand in the investment industry. Not only the private sector is concerned or interested in derivatives, also the public sector sometimes are interested or engaged in derivatives. In the crash that happened in the oil prices in the period of 2014-2015, one country emerged as a winner, which is Mexico. Mexico also produces oil, and oil is under the control of the government. The company that runs the production of oil under the direction of the government entered into options that set a certain price for the oil they produce. So when the oil price dropped below that price, they were able to sell it at a higher price compared to its other competitors. So I can see also that even in the public sector, there are applications that involves options. By this slide, we reach the end of our discussion of chapter 1. I hope the material I covered in chapter 1 stimulate your interest in the rest of the course, and moving forward we will be looking at derivatives in more details. Thank you for listening, and good luck.